Just days after surviving a coup attempt, the nation's revolutionary leader, Ibrahim Traore, has signed a significant new gold mining deal.
What happens when a small African nation dares to seize its gold back from the world's most powerful mining companies? That's exactly what Burkina Faso has just done, nationalizing 5 mines, demanding up to 50% of one of its biggest gold projects, and shaking the global industry overnight. Investors call it chaos. The government calls it freedom. But why take such a risk now? And what could this mean for Africa's future? Let's find out. Burkina Faso's government stunned the world with an announcement that few believed possible. 5 gold mines, long operated by foreign companies, would be seized and transferred into state hands. The move was not gradual. It was not negotiated in backroom deals. It was declared outright, with full ownership handed to a newly empowered state-run company, the Société de Participation Minière de Burkina (SOPAMIB). The news did not trickle through quietly. It detonated like an explosion across trading floors in Toronto, Sydney, London, and New York. For years, Burkina Faso had been seen as part of the standard model: African soil, Western capital. Gold mines churned wealth into global markets while the host country survived on modest royalties and a thin slice of equity. Yet in a single announcement, that model was thrown into question. Investors woke up to a new reality. In one of the world's fastest-growing gold frontiers, the state had just become the dominant player. The impact was immediate. West African Resources, the Australian-listed company developing the massive Kiaka gold mine, was forced to halt trading as markets digested the shock. Analysts scrambled to issue new reports. Bloomberg, Reuters, and the Financial Times rushed out alerts with a common theme: instability. Words like risk, uncertainty, and political gamble dominated their coverage. But in Ouagadougou, the government was not speaking the language of risk. It was speaking the language of sovereignty. The announcement did not stop at nationalization. In the same breath, authorities confirmed that under the country's new mining code, the state's equity stake in all existing projects would rise from 10% to 15%. And in a move that truly rattled the market, officials revealed plans to acquire up to 50% ownership of the Kiaka gold mine, one of West Africa's most promising deposits. It was a demand that foreign companies never expected from a landlocked, aid-dependent country, often dismissed as too fragile to play hardball. Why did this strike so hard? Because gold is not a minor industry in Burkina Faso. It is the backbone. The country has quietly risen to become Africa's 4th largest gold producer, surpassing giants that once dominated the sector. With production exceeding 57 tons in 2023, the nation has become indispensable to global supply chains. A disruption here does not just unsettle Burkina Faso. It shakes the very foundation of gold markets that hedge funds, jewelers, and central banks rely upon. Yet beyond the market mechanics, the symbolism was even more powerful. For decades, Africa's natural resources have been spoken of in terms of partnerships and foreign direct investment, polite language that masks the reality of lopsided contracts. Burkina Faso's move tore off the mask. It said, in blunt terms, the era of outsiders holding the lion's share is over. The reverberations of this decision extended beyond finance. Politically, it signaled that Burkina Faso's leadership was willing to confront some of the world's most powerful economic interests, even in the face of backlash. Regionally, it sent a message to neighbors like Mali and Niger, both gold producers themselves, that there was another way forward, one where sovereignty trumped stability in the eyes of foreign investors. And globally, it forced uncomfortable questions. If a nation as small and landlocked as Burkina Faso could take such bold steps, what would stop larger African players from following? Would Ghana, Tanzania, or the Democratic Republic of Congo be next to tear up old contracts? Was this the beginning of a continental wave of resource nationalism that could reorder Africa's place in the global economy? Burkina Faso's leaders knew these questions would come. They also knew the headlines in Western media would be filled with warnings of capital flight and investor panic. But they made the announcement anyway, with deliberate force, because for them, the question was no longer whether foreign firms would stay or leave. The question was whether Burkina Faso could afford another decade of giving away its wealth. The decision was made. The mines were nationalized. The government's stake was raised. The challenge had been issued. But here lies the real mystery. What drove Burkina Faso to take such a dramatic gamble now, at this moment, in this way? For Burkina Faso, the answer lies in a reality too stark to ignore. The numbers no longer add up. While the country exported tens of tons of gold every year, its state coffers remained thin, its development stunted, and its people disillusioned. Gold was supposed to be a blessing, yet it had become a paradox. In 2023, Burkina Faso produced over 57 tons of gold, making it the fourth largest producer on the continent. But the benefits reaching ordinary citizens remained shockingly small. Roads crumbled, hospitals ran short of medicine, and schools struggled with overcrowding. The government's share from the sector, through royalties and a meager 10% equity stake in projects, was simply not enough to transform the economy. This frustration had been building for years. Communities living near mine sites had long complained of environmental destruction and the displacement of farmland. Villages often saw little more than dust, while billions in profits flowed out to foreign shareholders. Meanwhile, the government faced rising costs, security operations against armed groups, infrastructure demands from a growing population, and the urgent need to stabilize a fragile political transition. Against this backdrop, leaders began asking the obvious. How much longer could Burkina Faso remain a spectator in the exploitation of its own resources? The timing of the gamble was not random. A surge in global gold prices in 2025, up nearly 27%, suddenly made the stakes higher than ever. Gold had become one of the most valuable assets in a world rocked by inflation, geopolitical conflict, and financial uncertainty. Central banks were stockpiling it, investors were hoarding it, and yet Burkina Faso, the very country producing it, was not reaping proportional rewards. The government saw an opening. If ever there was a moment to demand a greater share, this was it. The world's dependence on gold gave Ouagadougou leverage it had not possessed before. There was also a political dimension. Since 2022, Burkina Faso has undergone a seismic shift in governance, with a leadership that rejected old dependency models and championed self-reliance. This leadership was not bound by the traditional caution of appeasing Western investors at any cost. Instead, it leaned heavily on the rhetoric of sovereignty and the will of the people. For them, mining was not just about economics, it was about dignity. Nationalizing assets and raising state stakes became a symbolic assertion that Burkina Faso would no longer be dictated to by shareholders in London, Toronto, or Sydney. But economic and political logic were only part of the equation. Security realities also weighed heavily. Armed groups, smuggling networks, and illicit mining operations were siphoning off vast quantities of gold from artisanal miners. Much of this gold slipped across porous borders, financing shadow economies and conflict. By consolidating control through SOPAMIB, the government aimed to tighten oversight and curb the leakage of wealth. Nationalization was, in this sense, not just about revenue. It was about plugging the holes in a system bleeding gold out of the country. At the same time, the move carried a clear message to Burkina Faso's neighbors in the alliance of Sahel states AES, Mali, and Niger. These countries share similar challenges: immense mineral wealth, persistent poverty, and heavy dependence on foreign mining firms. By acting boldly, Ouagadougou signaled that there was a path forward for the Sahel that did not rely on appeasing multinational giants. If Burkina Faso could demand more from its gold, why couldn't Mali do the same with its gold, or Niger with its uranium? The risk, of course, was massive. Investor anger could lead to reduced foreign capital. Companies might threaten arbitration or pull out altogether. Western governments could cut aid or apply diplomatic pressure. Yet, for Burkina Faso's leadership, these threats were less frightening than the alternative: another decade of dependency, with gold leaving the ground but the people remaining poor. This gamble, then, was not reckless. It was deliberate. It was born out of necessity, urgency, and a conviction that waiting any longer would mean condemning another generation to watch its wealth vanish abroad. Burkina Faso was saying, in effect, we would rather face storms of our own choosing than live forever under chains we did not forge. But as the nation charted this course, another question loomed large. How would the world react? Would investors adjust, resist, or retaliate? And what would this mean for the future of mining in West Africa? Let's pause for a second to say big thank you to the Black Culture Diary community, where Black voices, stories, and legacies are preserved and amplified. By becoming a member, you're not just supporting the channel, you're becoming part of a powerful cultural movement. Let's continue. Almost immediately after Burkina Faso's announcement, a wave of panic rippled across financial centers. Mining firms with operations in the country scrambled to reassure their shareholders. West African Resources, the company behind the ambitious Kiaka project, was forced into a trading halt on the Australian Stock Exchange. Analysts who had once touted Burkina Faso as a rising frontier for mining investment suddenly shifted their tone, warning of a volatile and uninvestable climate. This was more than just a market hiccup, it was a seismic jolt. Mining giants like IAMGold, Endeavour Mining, and Nordgold had long built their business models on predictable state shares and stable tax regimes. A sudden increase in government ownership, let alone outright nationalization, upended those models overnight. For years, investors had relied on the assumption that African governments, no matter how politically turbulent, would still prioritize foreign capital to keep projects afloat. Burkina Faso's boldness shattered that assumption. Western media quickly amplified the unease. Headlines in London and New York framed the move as a reckless gamble that would deter investment and destabilize the West African mining sector. Financial newspapers spoke in dire tones about resource nationalism spreading like wildfire. To many observers outside Africa, the government's decision looked like a red flag that signaled the return of an era investors thought long buried, when states reclaimed mines without the blessing of corporate boardrooms. But what truly unnerved investors was not just what Burkina Faso had done, but what it might inspire. Gold had surged nearly 27% in 2025, becoming one of the world's most sought-after safe haven assets. This made the stakes higher than ever. If other African states followed Ouagadougou's lead, billions in global capital tied up in African mining could suddenly be exposed to the same risks. Investors asked themselves hard questions. If Burkina Faso could push its stake to 50% in Kiaka, what would stop Mali from renegotiating its contracts? If 5 mines could be nationalized in a single announcement, what guarantee existed that more wouldn't follow? The nervousness wasn't just theoretical, it had material consequences. Reports surfaced of private negotiations between mining companies and their lenders, as firms sought reassurances that financing would continue despite the new climate. Rumors spread of possible arbitration cases against Burkina Faso, with investors exploring whether international legal frameworks could protect them. Yet even these mechanisms seemed uncertain, because the political will in Ouagadougou was unshaken. Unlike governments in the past, Burkina Faso appeared ready to weather sanctions or lawsuits if that was the price of sovereignty. Beyond investor boardrooms, the panic trickled into political channels. Western diplomats raised concerns about the business environment in private conversations with Burkinabe officials. Trade representatives warned of shrinking investment pipelines. Behind the scenes, some Western governments considered whether aid or security support could be used as leverage to pressure the government into softening its stance. But in a world where new partners, Russia, China, Turkey, and Gulf states, were eager to engage, the old levers no longer seemed as effective. Investors feared that if they pulled out, others would simply step in. In Africa, however, the reaction was different. From Bamako to Kinshasa, policymakers and civil society groups watched the fallout with fascination. Burkina Faso's move raised an uncomfortable but electrifying question. Had the balance of power between African states and multinational mining firms just shifted? If so, then the panic in global markets was not a sign of recklessness. It was a sign that the old order was cracking. For the companies themselves, the options were limited. Some hoped for quiet negotiations to protect their assets. Others threatened legal action. A few even hinted at scaling back operations until the climate normalized. But the government's message was consistent. Normalization would no longer mean a return to the past. Investors could adapt, or they could leave. The panic revealed something profound. For decades, it was assumed that Africa needed investors more than investors needed Africa. Burkina Faso's move turned that logic on its head. With gold in high demand and prices soaring, the world's need for Africa's minerals suddenly outweighed Africa's need for foreign capital. But panic alone doesn't build a nation. The question that followed was crucial. Now that Burkina Faso had rattled investors and seized greater control, how would it turn this leverage into real development for its people? Here's a reminder to please like and share the video, and subscribe to our channel to watch more videos on Black culture, history, civilization, and identity. Let's continue now. What good is reclaiming gold if it never shines on the people who live above it? This is the defining question that Burkina Faso's leaders now face. It is one thing to seize ownership and rattle investors. It is another to turn that control into tangible development. Nationalization without transformation risks becoming symbolic. That is why the government has framed its gold strategy not simply as taking assets from foreign hands, but as reshaping the very purpose of the sector. Gold has long been the backbone of Burkina Faso's economy, yet the majority of its value is left in the country in raw form. That cycle is now being challenged. Authorities have made clear that raw exports can no longer be the model. Instead, emphasis is shifting toward local processing and refining. Plans are under discussion for the establishment of industrial-scale refineries capable of producing bullion domestically, ensuring that Burkina Faso no longer ships away raw ore only to buy back finished products at exorbitant prices. This is more than economics. It is psychological warfare against a system that treated African nations as suppliers of unprocessed wealth. Equally important is the question of artisanal mining, a sector often left in the shadows. Tens of thousands of Burkinabe depend on small-scale mining for survival, yet much of their output historically slipped into illicit channels, fueling smuggling networks. Rather than criminalizing these miners, the government is seeking ways to formalize their role, integrate them into legal frameworks, and ensure their production strengthens national reserves. This move carries a dual benefit: stabilizing livelihoods for rural communities while blocking the leakage of gold into underground markets. Revenue allocation is another cornerstone. Officials insist that increased state stakes are not meant to bloat bureaucracy, but to finance long-term projects. Gold profits are being eyed as funding streams for roads, energy grids, schools, and hospitals. In a country where infrastructure gaps have slowed economic growth, redirecting mining wealth into physical development could have a generational impact. The symbolism is powerful. Where foreign shareholders once celebrated annual profits, Burkinabe children might instead celebrate new classrooms and functioning clinics. The vision also extends to industrial diversification. Relying solely on raw gold exports is dangerous, especially in a world where commodity prices can swing with global shocks. By using gold revenues strategically, the government hopes to seed investments in agriculture, manufacturing, and even renewable energy. If successful, this would mean that gold, a resource often accused of cursing nations with dependency, could become the foundation for breaking that very curse. Critics argue that such ambitions are easier to declare than to deliver. Building refining plants requires technology and expertise. Channeling artisanal production into legal markets demands strong oversight. Ensuring that revenues are not lost to corruption requires transparency that many African states have historically struggled with. Yet the government counters these doubts with a simple principle: the first step toward building is owning. Without control of resources, there is nothing to invest. There is also an ideological layer to the nation-building agenda. For President Ibrahim Traore's government, gold is not just an economic asset, it is a symbol of sovereignty. Turning it into visible development projects is essential to legitimizing the broader political project of independence. The government understands that Burkinabe citizens will measure success not in policy documents, but in real-life changes: electricity in rural homes, paved roads where there was once dust, and jobs where there was once despair. If these benefits materialize, gold nationalization will not just be remembered as a gamble, but as the moment when Burkina Faso rewrote its destiny. Still, one question lingers like a shadow. Can Burkina Faso's bold model inspire others across the continent, or will it remain a solitary experiment? This is the question reverberating across the continent. For decades, African states have been told that investor security was paramount, that contracts signed under unequal conditions must be honored, and that nationalization was a relic of a bygone era. Burkina Faso's bold strike against this orthodoxy has reopened the debate, not just within West Africa, but across the entire resource-rich continent. Already, eyes have turned to the alliance of Sahel states AES, the new bloc uniting Burkina Faso, Mali, and Niger. These three nations, bound by geography and political upheavals, now share more than just borders. They share an ambition to reclaim sovereignty over their most valuable resources. For Niger, that resource is uranium, long controlled by French companies. For Mali, it is gold, where foreign operators still dominate. With Burkina Faso setting the precedent, it is no longer unthinkable that Mali might renegotiate contracts or that Niger could demand greater control of uranium exports. Together, the AES could transform itself into a fortress of resource sovereignty, defying not only investors, but also the geopolitical weight of former colonial powers. The ripple effect stretches further. In East Africa, Tanzania has already forced global miners to rewrite contracts, ensuring larger state revenues. Zimbabwe has tightened its grip on lithium, declaring the mineral a strategic asset critical to its industrial future. DR Congo, home to the world's richest cobalt deposits, has revisited deals with Chinese and Western firms alike. The pattern is unmistakable, a growing refusal to accept the old logic that Africa should supply raw materials cheaply while importing expensive finished goods. Burkina Faso's nationalizations have injected fresh energy into this movement, proving that even smaller states can stare down multinational giants. Western investors and governments view this trend with alarm. Editorials in global financial papers warn of a contagion of nationalism. Legal advisors for mining companies speak of arbitration cases that could pile up in international courts. Yet such fears also reveal the shifting balance of power. A continent that was once a price taker is learning to become a price setter. With gold, lithium, cobalt, uranium, and rare earth minerals increasingly critical to global industries, from smartphones to renewable energy, Africa's leverage is stronger than ever. This doesn't mean the road ahead is smooth. Each country faces its own challenges: corruption, capacity gaps, and security threats that could undermine the promise of resource sovereignty. Critics argue that nationalization risks inefficiency, pointing to failed experiments in the past. But Burkina Faso's strategy is not simply about seizing assets. It is about transforming them into engines of development. If it succeeds in turning gold into schools, hospitals, and factories, it will create a model that others can follow with confidence. For Africa's youth, who make up the majority of the population, the stakes could not be higher. Generations have grown up watching their nations export untold wealth while struggling with unemployment and underdevelopment. A new model where resources are controlled, processed, and reinvested locally offers the possibility of breaking that cycle. Burkina Faso's gamble, then, is not just about gold. It is about inspiring a continent to believe that the riches beneath its soil can finally serve its people first. The echo is already being heard. Civil society groups in Ghana, Nigeria, and Kenya are asking their leaders tough questions. If Burkina Faso can demand a bigger share, why can't we? This is the quiet revolution spreading across Africa, not fought with weapons, but with laws, contracts, and the assertion of sovereignty. And so, the final question remains: will Burkina Faso's audacity mark the beginning of a continental shift, or will it stand as an isolated experiment? The answer will depend not only on Ouagadougou's ability to deliver results, but also on the courage of Africa's other leaders to follow its example. What is certain is this: the world can no longer ignore Africa's voice in the global resource economy. And it was Burkina Faso, against all odds, that forced that voice to be heard. Do you think more African nations should follow Burkina Faso's lead and nationalize their resources? Let us know in the comments section. Is this the start of Africa finally breaking free from Western control over its wealth? Do you want to watch more videos like this one? If so, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: the Black culture, civilization, history, and evidence about how glorious Blacks have been. Thanks for watching, and until the next video, stay tuned.